Hello, my name is David Stone, a senior manager in BerryDunn's financial services practice group, and I'm really excited to share with you today some information on CECL disclosures. Up to this point, I think a lot of the focus has been on the CECL calculations, the documentation surrounding those calculations, and rightfully so. That's obviously a huge part of CECL adoption. But I think what we'll find out today is that there's a lot changing on the disclosure front too, as a result of this accounting standard update. So we're going to dive in, go over a lot of info, provide some hopefully useful resources that you can walk away with and use in your institution's adoption. So to start, I just want to provide what I like to call a 30,000-foot view, super high level. Where in the guidance is all this disclosure info found? And it's really found in two spots. You have ASC 326-20-50. So that's going to cover your financial instruments measured at amortized cost. So your loans, your off-balance sheet commitments. And then 326-30-50 is going to be for your available for sale debt securities. Now, the CECL standard doesn't necessarily apply to available for sale or AFS debt securities, as they're commonly called, but there are some targeted changes to the accounting for AFS debt securities and the disclosures for such, as we'll see. So those are covered in 3050 in the codification. Now, this next slide really comes directly out of the codification. In general, this is what we're trying to accomplish with our CECL disclosures. So the disclosure guidance should enable a user of the financial statements to understand the following: the credit risk inherent in a portfolio, how management monitors the credit quality of the portfolio, management's estimate of expected credit losses, probably to no surprise. Then lastly, changes in the estimate of expected credit losses that have taken place during the period. So it's as simple as that. That's all we're trying to accomplish with these disclosures. Of course, there's a lot of, input and detail that goes into making those disclosures, but from a super high level, this is what we're trying to accomplish. Now, I have a direct quote from the codification that I'll read for you real quickly, and I included it because, again, I think it just really kind of sets the playing field for these disclosures. Really tells us what we're trying to do, and I'll also provide some, I guess you could say, cautionary advice when crafting your CECL disclosures. So the codification says an entity must strike a balance between obscuring important information as a result of too much aggregation and not overburdening financial statements with excessive detail that may not assist the financial statement user in understanding the entity's financial assets and allowance for credit losses. For example, an entity should not obscure information by including it with a large amount of insignificant detail. Similarly, an entity should not disclose information that is so aggregated that it obscures important differences between the different types of financial assets and associated risks. Now, to put that maybe a little more succinctly, I kind of look at it as like the Goldilocks approach. You don't want too much, you don't want too little. You just want to be right in the middle, right in that sweet spot with your CECL disclosure. There's, as we know, a lot of information that goes into developing your allowance for credit losses, arguably more than there was under incurred loss. A lot of that information is important, but a lot of it probably isn't important as well in the context of your financial statements. So it's just finding that right balance as to what's important, what should be disclosed, and what can probably be left out from those disclosures. And I think, the answer to this is different from institution to institution. So it's definitely, worthy of a conversation internally with your CECL team. as well as with external parties. You know, maybe it's your CECL vendor, if you're using one, certainly your auditors, chatting with them and just kind of seeing what they would expect. All right, so a few key points here that I want to point out on CECL disclosures. So, you know, as I mentioned earlier, although there are some similar requirements, I would say in general, the new CECL disclosure requirements are significantly different than the previous requirements, significantly different. And this is key because there's probably a lot of areas in these disclosures that are going to require you, somebody in the organization, to gather information that they may have not had to gather before. And it's going to be important to A, figure out how to gather this info, and B, you know, make sure that it's actually the information that you need to support the disclosures and the financials. So it's never too early to plan for these new disclosures. You know, start poking around, figure out where's this information in your core, where is it in your CECL model. Make sure you have access to it, and it, you know, the accessibility of it is going to depend too. There might be instances where there's some fairly significant manipulation that needs to be done to a data set to get it in disclosure ready form. So keep that in mind. Number 2 here, CECL does not just apply to loans. Hopefully not a surprise to many of you, but it applies to all financial instruments carried at amortized cost. So again, this could be your off-balance sheet commitments, your held to maturity debt securities, that would fall under this category as well. So as we'll see in some resources that we'll provide in a few slides here, you know, you're going to have disclosures around all those types of instruments, not just your loans. Number 3, so year of adoption will include additional disclosures to disclose the adoption's impact on the financial statements. This is a huge change to your financial statements. I mean, you think about it, your loan and allowance footnote, it's probably been in the 60 to 75% range of your financials. Like it's consumed 60 to 75% of your total financial statement document. This is a huge change to your financial statements. So accordingly, there's going to be a lot of disclosure in that year of adoption just to explain what has changed from last year to this year. Number 4 here, so troubled debt restructurings are no longer, but there are new loan modification disclosures that will need to be made. This is another great example where this is likely information that you have not been tracking historically, but now you will have to track. And just to dive into this one a little more, just to provide a little context. So these new loan modification disclosures only need to be made for modifications made to borrowers experiencing financial difficulty. So if you make a loan modification to someone that your institution has deemed is not experiencing financial difficulty, that does not need to be disclosed in the footnotes. It's only those mods that are to those experiencing financial difficulty. So a key difference there that needs to be considered when gathering the info that needs to be disclosed. And we'll dive into this one a little more in a few minutes as well. Now, number 5 here, so disclosure information must be provided by either portfolio segment or class of financing receivable. Now, the definition of portfolio segment, this comes right from the codification, is that it's the level at which an entity develops and documents a systematic methodology to determine its allowance for credit losses. So essentially, however you're slicing and dicing your loan portfolio in your CECL model, that's how it should be disclosed in your financial statements. So for instance, if you're using call report code to develop your loan pools, you know, if you've deemed that that's what distinguishes the risk characteristics of your overall loan portfolio, that would be your portfolio segments. That would be your portfolio segments. Now, the class of financing receivable, real simply is a really tended to be looked at a further disaggregation of your portfolio segments. So, you can, if you so elect, to further disaggregate those portfolio segments. In practice, we don't typically see that, but it is allowable under US GAAP. All right, so I've mentioned a few times, some resources that we have available. So what I want to share a sample CECL disclosure that we have available for download on the BerryDunn website. Highly recommend checking it out, downloading it. Even if you just use it as a reference point, you'll hopefully find it a worthwhile resource. Now, I should mention that this resource is really developed for the discounted cash flow methodology. So those of you that are using a DCF methodology. That being said, there's a lot of info in this sample disclosure that will be applicable to all methodologies, whether it be, warm or, another type of methodology. A lot of this info can still be extracted and used in other types of methodologies. So another thing I want to point out, kind of a disclaimer, if you will, is that this sample CECL disclosure is really focused on those disclosures related to CECL. There's likely other disclosures in your financial statements that will need to be made that are still related to loans, for instance, that are not included in this sample CECL disclosure. So an example could be like related party loans. You won't see that in this sample disclosure here, but that's still a requirement to be disclosed. So a few things I want to point out. We're not going to go over this document page by page, but there are a few things that I think are worth bringing to your attention to hopefully help you as you navigate this document. So I'm going to jump around. I'll try to provide page numbers just as reference points for you folks. So I've jumped down to page 3 here in the document, and the only thing I want to point out is again, remember, CECL does not just apply to loans. It applies to financial instruments carried at amortized cost. So you could have a credit loss expense certainly related to your loans, but also related to held to maturity debt securities, off-balance sheet commitments or credit exposures. You could have credit loss expense in all 3 of those buckets, for instance. So although not necessarily a requirement, we think it's prudent to disaggregate that credit loss expense by these different buckets. And this could be on the face of the financial statements, right in your income statement, or it could be in a footnote disclosure as well. So I should mention that this sample CECL disclosure is meant to be I guess you could say a one size fits all. What I mean by that is that it's meant to capture those disclosures that are unique to public business entities and SEC filers, and of course, those that are applicable to everyone else too, your non-public business entities. And we do have a key at the top of this disclosure meant to guide you in making that determination as to if a disclosure is relevant to your institution. There's also some stuff in here that may or may not be applicable. We've tried to highlight those items that may be applicable to some and not applicable to others. But again, it's really going to take your judgment ultimately to make that decision. So as I mentioned on a previous slide, this is a huge change to your financial statements. So, there's an expectation that there's going to be a fairly robust disclosure on the adoption of this accounting standard. And this page right here, page 4, really is where you start that conversation of that adoption. And that disclosure should include, if I go down to page 5 here, some information just kind of comparing pre and post adoption. Doesn't necessarily have to be in a tabular format, but maybe, just showing where you were pre ASC 326 and then of course post CECL implementation. So on page 6 here, just a real quick thing that I want to point out is that accrued interest receivable. There's a practical expedient in the codification that allows you to exclude accrued interest receivable from your calculation. However, if this practical expedient is adopted, you are required to disclose the dollar amount of your accrued interest receivable, as well as the placement of that accrued interest receivable in the financial statements. So as an example, we see that disclosure here for available for sale debt securities about in the middle of this page, where we disclose the dollar amount as of, in this case, year end, and where it's reported in the financial statements. So here it's in accrued interest receivable and other assets, but that placement, of course, could change. So going up to pages 8 and 9 in the disclosure, one thing I want to mention, I mentioned earlier that the Goldilocks approach, just disclosing just enough info to provide enough detail on how your model works. And this is, we really see that exhibited throughout the disclosures, but this is one spot where it really starts. And I should mention everything that I've shown so far is in the summary of significant accounting policies footnote. Doesn't have to necessarily be there, but that's just how it's laid out in this sample CECL disclosure. So in this significant accounting policies footnote, we start to lay the groundwork as to how our CECL model works. So you'll notice really towards the bottom of this page here, we start to talk about reasonable and supportable forecasts, qualitative adjustments, what we're looking at when we're considering qualitative adjustments. And then on page 9, we start to get into the actual model that we're using. So towards the top here, start talking about the discounted cash flow model, as well as some of the macroeconomic drivers that are being used in the model that are ultimately driving the model results. So as we'll see, more to come on these model specific disclosures, but this is just kind of where that starts to get embedded into the financial statements. So on page 11 here, we're done with our significant accounting policies. We're now looking at our financial statement line item specific disclosures. And maybe thankfully, the securities or investments disclosure is largely unchanged. You'll notice you still have your amortized cost, your gross unrealized gain and loss disclosures. I guess one difference here is that we have added this allowance for credit losses column to this table. Otherwise, though, not a whole lot's different. You still have your maturity disclosures on page 12 here. However, there are a few things that I'll point out that have changed. So for instance, on page 14, we essentially have a roll forward of the ACL on, in this case, available for sale debt securities. Now, keep in mind, a roll forward as a table here may not be appropriate for your institution. For instance, if you don't have any credit loss on your AFS debt securities, likely doesn't make sense to have a table just with zeros. You can probably just disclose that narratively and forego having a full-blown table in the financial statements. Now on page 15, you now must disclose credit quality indicators for your investments. And a couple different ways to do this. You could do this here in tabular form, where we've broken out the investment securities by bond grade, so AAA, BBB, for instance, or you could do this narratively, which is what we typically see now for disclosures surrounding credit quality. We see a narrative disclosure describing the different credit quality indicators that are being used to assess investment securities. So now going ahead to your loans and allowance for credit losses. So I've jumped down to page 18 here, and this is where, about in the middle of the page here, this is where we start with the portfolio segments. So for this institution, these would be your portfolio segments: commercial real estate, residential real estate, home equity, consumer. That's how they've elected to slice and dice, so to speak, their loan portfolio. Now, as I mentioned earlier, if I jump down to page 21 here, there's a lot of model specific info that need to be provided in the financial statement disclosures. So in a way, you could look at this page here, 21, as a continuation of those model specific disclosures that we saw in the significant accounting policies footnote. But here we're just providing even more granular detail as to how the model works. So again, we have our macroeconomic or loss drivers, where we're talking about the different portfolio segments, what loss drivers we're using for those portfolio segments. Start talking about the reasonable and supportable forecast period, the reversion period, prepayment speeds, qualitative factors. All that information is included in this disclosure. And again, this is going to change by institution to institution. Even those institutions that are using DCF, this disclosure will look different depending on how you're utilizing DCF and what decisions management has made in creating their CECL model. And it'll certainly change if you're not using DCF too. You know, the inputs, the judgments that management is making are likely going to look different. You know, for instance, if you're using WARM versus DCF. So just keep that in mind when crafting your disclosures. Now, also on 21 here, we start our discussion of credit quality indicators on loans, and should look and feel pretty similar to current disclosures, you know, where we're going to break down our, you know, loan pools by credit quality indicator. In this institution, I should note they've elected to use risk rating for most of their portfolio segments, I should say, but that's not a requirement. You know, risk rating doesn't have to be the credit quality indicator that's used by your institution. Could be past due status, for instance. You know, maybe that's the credit quality indicator your institution deems most relevant. So now on page 23, we start our vintage disclosures. And before I even start chatting about these vintage disclosures, I do want to mention these are just required for public business entities. Now, for the SEC filers, all 5 years here are required from day one. So you have to provide the last 5 years of disclosure, and then everything else will fall into that prior column. Now, for public business entities that aren't SEC filers, you have the option to phase in this disclosure. So in year one, the year of adoption, you have to present the last 3 years. And then next year, you'll add a 4th year. Then the year following, you'll add your 5th year. And then you'll just keep that 5-year period rolling forward. So, and, you know, these disclosures are, I think, pretty neat. You know, I think this will definitely provide useful information to financial statement users, especially the last line in this disclosure, the current period gross write-offs. These gross write-offs will start to show the trend as to where your institution is experiencing write-offs. You know, what vintage year is experiencing some headwinds. This disclosure will start to show that. And I should note this disclosure is broken out by those portfolio segments. So on page 23 here, we have the disclosure for commercial. It's broken down by those credit quality indicators, risk rating. And then if I skip down to like home equity, for instance, you'll notice that we're not doing risk rating here. We're actually doing performing versus non-performing. That's the credit quality indicator this institution has decided is most relevant for its home equity. Then if I go to page 27, also for its consumer portfolio segment. So a really neat disclosure. However, for those that it's required, you know, there's likely going to be a lot of work in gathering this detail, especially in year one. You know, hopefully going forward, it'll be a bit more efficient of a process. Now on page 28, nothing earth-shattering here, but I still think worth pointing out, your non-accrual loans. You're still required to disclose non-accruals. However, now you must further disaggregate non-accrual loans by those non-accrual loans that have no allowance for credit loss. And again, this is going to be by portfolio segment. And then also another, I guess you could say, unique disclosure requirement is that you have to disclose non-accrual loans at the beginning of the period as well as the end. So you'll notice here we have total non-accrual as of January 1st and then as of December 31st for our calendar year-end sample institution. And then again, nothing too earth-shattering, but wanted to point it out. You now must disclose, again, by portfolio segment, collateral-dependent loans and what collateral type creates that dependency. So it could be real estate, could be all business assets, and how we've elected to provide it in the sample CECL disclosures just via columns, for your collateral type. And then you'll just disclose the dollar amount by portfolio segment. So lastly, if I skip to page 31 here, I mentioned the new loan modification disclosure requirements way at the beginning of the session. Time to bring it full circle. So again, the loan modification disclosure requirements are only required for those loan mods to borrowers experiencing financial difficulty. That's it. They're not experiencing financial difficulty. Don't have to worry about them, at least for this conversation. So what the new disclosures require is that you disclose the type of modification. And the codification is very specific as to the types that you need to disclose. We have them listed right here on page 31. So you have principal forgiveness, payment delay, term extension, and interest rate reduction. That's it. Those 4 types are the types of modifications that you're going to disclose. Now, however, if you have a loan that's modified in more than one way, so maybe it's principal forgiveness and term extension, for instance, you will not disclose that loan twice, once in the principal forgiveness bucket and again in the term extension bucket. Rather, you'll create a separate bucket, so to speak, and disclose it there. So you'll see we already have it actually set up here that 5th column says combination, term extension, and principal forgiveness. That modification would be disclosed in that column and in that column only. So in general, just think a loan that's been modified is only going to be disclosed in one spot in this table, depending on the type of modification. So a few other things I'll point out, all specific to these new loan mod requirements. You must disclose the past due status of those loan modifications, as well as the financial effect of the loan modifications for the year in the modification. So that's this last table here where we're showing the dollar amount of the principal forgiveness, the percentage reduction in interest rate, and then the change in term extension. Those last 2, your percentage reduction and your change in the term extension, those are going to be on a weighted average basis when disclosed. So with that concludes really what I want to cover on CECL disclosures today. Hopefully your head isn't swimming too much. I know this is a lot, as I said at the top of the session, a lot of the focus has been on the calculations, the documentation of such. And again, certainly rightfully so. But there's a lot here with the CECL disclosure requirements that are going to start to take front and center, as you start to prepare your financial statements. And I'm hoping that this session today will be helpful in just providing some guidance, kind of providing some guardrails maybe on how to tackle these new requirements. And again, the sample CECL disclosure is available on the BerryDunn website for download. Highly recommend downloading it. Maybe you use it as a starting point, or again, just as a reference as you start to craft your disclosures. And certainly don't hesitate to reach out to the BerryDunn Financial Services team. We're certainly happy to assist. So thank you very much.